You are listening to The Vocal Technologist. Spoken tech for your ears.
So, quick question for you. Have you checked your bank account this morning?
Uh-oh. I'm almost afraid to ask why.
Well, I don't mean checking to see if you have enough for that, oat milk latte. I mean checking to see if your bank has been acquired by a YouTuber yet.
Given the news this week, that is a surprisingly legitimate concern. Or maybe you should be checking if your financial advisor was just quietly replaced by a piece of code.
A piece of code that doesn't just suggest stocks, but actually goes out and buys them while you're asleep.
Exactly.
It really feels like that, doesn't it?
Oh.
We're looking at a week where the numbers on the board are just staggering.
I mean, the scale is something else. Valuations hitting $140 billion, $5 billion raises.
$82 billion bets. It's like the entire financial world just decided to change the rules of the game at the exact same time.
It's definitely not a quiet week. The amount of capital moving around suggests we're in a new phase of fintech. It's not just about shiny apps anymore.
Absolutely. And that's just another day for us here on The Vocal Technologist. Today, we're jumping into a special Founder Fridays FinTech edition. We're not just looking at stock tickers. We're looking at a fundamental shift in how money moves, who controls it, and maybe the scariest part, who or what is now writing the code.
Right. We're seeing a move away from the human-in-the-loop model to something far more autonomous.
We are going to cover the so-called SaaSpocalypse, a credit card company that decided to just cut out Wall Street, and why your next wallet might belong to an AI. But first, we have to start with the biggest number, the elephant in the room, Stripe.
The $140 billion elephant, yes.
So let's break this down. Stripe is arranging a new tender offer, valuing the company at $140 billion.
Which is up $30 billion from just last year.
Right. And here's the thing that gets me. They're profitable now, as of 2024.
Mm-hmm.
So what exactly is a tender offer in this context? Because it sounds like they're selling chicken.
It does, doesn't it? But no, a tender offer is basically a mechanism for liquidity. Since Stripe is private, you can't just go sell your shares on an app. In a tender offer, the company or an investor offers to buy shares from existing shareholders, usually employees, at a set price.
Okay, so normally a company this big would IPO. Ring the bell, confetti falls, early employees finally get to sell their stock.
That is the traditional path. The pressure to IPO almost always comes from those early investors and employees who want to cash out. They want to buy a house after working for 10 years.
But Stripe is basically telling the public market,
we don't need you.
that is a massive flex.
It really is. By doing these regular tender offers, they give employees the cash they want without taking on the whole burden of being a public company.
No quarterly earnings calls, no analysts breathing down their neck.
Exactly. They're using their own profits and private capital to stay in control.
It feels like this stay private longer thing is really gaining steam. But if we're talking about power moves, we have to talk about Revolut.
Oh, absolutely. While Stripe is ignoring Wall Street, Revolut is actively, they're cutting them out of the deal entirely.
This, to me, is the most fascinating story of the week.
Right.
Revolut is valued at $75 billion, but that's not the real headline.
No, the headline is their internal financial strategy group.
I had to read this twice. So usually if you want to organize one of these share sales, you hire a big bank, right? You call Morgan Stanley, you pay them a huge fee, and they handle it.
Correct. That is the standard Wall Street toll booth model. But Revolut just decided to build that in-house.
And here's the crazy part. They didn't just save on the fees. They actually made a profit.
A huge profit.
Okay, drill down on this for me. The report says they generated hundreds of millions of dollars in arbitrage gains. How do you make money selling your own stock between two parties?
It's all about the spread. Think of it like this. Revolut is the one facilitating the deal. So they might agree to buy shares back from an early employee who wants cash now.
At a certain price?
Right, say at $100 a share. Then they turn around and sell those exact same shares to a new institutional investor who is desperate to get in for $120.
And they just pocket the $20 difference.
Exactly. They acted as the market maker. They captured the value that an investment bank normally would. They turned what is usually a cost center into a profit center.
Hold on. That seems borderline aggressive. Is that even common for a private company to do that?
It is extremely rare at this scale. It shows a level of sophistication and, frankly, a bit of arrogance that you usually only see in, like, sovereign wealth funds.
So they're signaling they don't need the traditional gatekeepers for anything.
It creates a new kind of moat, you know? It's not just about having the best app. It's about having the financial machinery to operate completely independently.
Speaking of operating,
Yeah.
let's shift gears to how these places are running. There's all this chatter about a SaaSpocalypse.
Right.
Software stocks apparently lost $285 billion in value. Is software actually dead? Because I still use a lot of it.
Software isn't dead, no. But the business model we've known for a decade is definitely in the emergency room.
You mean the per-seat model?
Yeah, exactly. I pay $20 a month for every employee who has a login. For years, that's how companies like Salesforce or Slack worked. It was a bet on headcount growth.
But now we're moving from humans using tools.
To agents doing work.
Right. So if one AI agent can do the work of 10 customer service reps, I don't need 10 licenses for that software anymore. I just need one API hookup for the AI.
And that just destroys the old revenue model. You can't charge for the human if the human isn't the main user anymore. And that explains the data we're seeing. UI-heavy software stocks are getting hammered, but infrastructure companies, they're booming. Just look at Databricks.
They just raised $5 billion at a $134 billion valuation.
Because Databricks is the plumbing. They're the data platforms that power all these custom AI agents. The market is betting we need fewer dashboards for humans and more data pipes for AI.
And if you want a real concrete example of that, let's go back to Stripe for a second. They just released some info on their internal coding agents.
The minions.
The minions. And the stats are kind of blowing my mind. These aren't just chatbots.
Not at all. This is a glimpse into the future of how software gets built.
Okay, so they are generating over 1,000 pull requests per week. For anyone listening who's not a coder, what's a pull request, and why is that number so insane?
A pull request is basically a finished packet of work. A developer writes some code, fixes a bug, adds a feature, and they submit it for review. That's the pull request.
And a human developer might do, what, a few of those a week?
A few, yeah. These minions are doing 1,000. And here's the most important detail. That's zero human-written code in those requests.
Wait, zero? So the AI is doing it from start to finish?
A human says, fix this mug in a Slack message, and the agent goes and writes the code, tests it, and submits it for deployment. All on its own.
It's the inflection point. It's not a helper, it's an autonomous worker.
Exactly.
Which, of course, brings up the uncomfortable question. What about the humans? I saw Goldman Sachs is partnering with Anthropic, the Claude AI people.
This is where it gets very real. Goldman is using AI to automate accounting, compliance, client onboarding, all of it.
And they're being very careful with their words, I noticed. The goal is not to fire people, but to constrain future headcount growth.
Which is the most polite corporate way of saying, we aren't hiring any more junior analysts next year.
Right.
There's this phrase going around with investors now, long APIs, short slides.
I love that. Long API, short slides. Break it down.
It just means you bet your money on the infrastructure that AI uses, the APIs, the databases, the cloud compute, and you bet against the things humans use to justify their jobs, like PowerPoint decks and fancy dashboards. The future is software talking to software.
Which is the perfect segue. If software is writing the code and doing the accounting, can it spend the money too?
According to Coinbase, the answer is yes.
They just launched Agentic wallets.
Yeah.
Which is a wallet for an AI agent.
This is a really big deal in the crypto space. They're built using something called the BIS-402 protocol.
Okay, BIS-402 protocol. That sounds super technical. In plain English, why can't I just give my AI my credit card number?
Well, you could, but that's a great way to go bankrupt very quickly. The BIS-402 protocol is basically a standard for giving a bot a controlled bank account.
Like a corporate credit card for an employee.
Exactly like that. You can set hard limits, you can track it, but you don't have to approve every single tiny transaction it makes.
So my AI assistant could realize it needs more processing power for a task and just go buy it.
It could buy it, it could pay for another API, it could even trade on DeFi markets without a human ever clicking approve. It shifts AI from being an advisor to being a transactor.
That is both incredibly efficient and mildly terrifying. I just see myself waking up and my AI has spent my life savings on a JPEG of a monkey.
Well, they emphasize the guardrails, but yes, the core idea is that AI agents are becoming actual economic actors now.
So we have AI coding, AI spending, and meanwhile, in the human world, the lines are blurring just as much. Let's talk about YouTubers becoming banks.
Ah, yes. MrBeast.
Beast Industries just acquired the fintech app Step, which is a banking app for teens, right?
Yeah, it's aimed at Gen Z, helps them build credit before they turn 18. It's got about 7 million users.
But why does a YouTuber need a bank?
It all comes down to customer acquisition cost, or CAC. This is what kills most fintechs. A traditional bank might pay hundreds of dollars in marketing to get one new customer.
Right, those junk mail offers for $200 to open an account.
Exactly. But MrBeast, his cost to acquire a customer is basically zero. He just has to put the app in one of his videos.
That's brilliant. He did it with chocolate, with Feastables. Now he's doing it with financial literacy.
It's vertical integration. He owns the audience, so why send them to Chase? He can keep them in his ecosystem.
So while MrBeast is betting on kids, Nubank is betting on America.
This is an $82 billion bet. They're already massive in Latin America, but now they're coming for the U.S. They've got conditional approval for a national bank license.
But the U.S. is so crowded. Why does their CEO think he can win here?
He's betting on the model's efficiency. Nubank is completely branchless. Their cost to serve a customer is a tiny fraction of what a legacy U.S. bank pays.
So he thinks that digital-first, low-cost model can just outcompete the big, heavy banks here, even if the returns are lower at first.
That's the bet.
And then, speaking of different approaches, over in the UK, Clio is back.
The AI assistant that bullies you into saving money.
I love this concept. For anyone who doesn't know, it's a money app with a roast mode. It will literally insult you for spending too much on takeout.
It sounds funny, but it works. It humanizes the whole interaction and turns financial discipline into a conversation instead of a spreadsheet.
Okay, let's do a quick lightning round on the plumbing that makes all this work. Visa just launched something that could kill the little square card reader dongle for good.
The tap-to-phone SDK. It lets an iPhone accept payments directly.
No extra hardware at all.
None. The phone's NFC chip becomes the payment terminal.
That is huge for small businesses. The barrier to entry to accept payments just dropped to zero.
It makes the phone the absolute center of all commerce.
And on the weirder side of things, prediction markets are having a huge moment.
They really are. Apex FinTech is enabling event contracts so people can bet on sports, politics, the economy.
And it's not just finance nerds. NBA star Giannis Antetokounmpo is investing in a platform called Kalshi.
It's a rare crossover, for sure, but it has not been without some drama.
Oh, the Kalshi drama. I saw something about extortion.
It was a mess. A report came out claiming users lost money faster on Kalshi than on gambling apps. Kalshi's first response was to claim the data startup behind it was trying to extort them.
That is a serious accusation to make.
It is, and then they had to walk it back completely. They said they reviewed more information and no longer believed it was extortion. It just shows how high the stakes are getting.
It's never dull. Okay, let's zoom out. AI agents writing code at Stripe, AI wallets spending money at Coinbase, YouTubers owning banks. What's the big picture for, say, 2026?
I think we're entering the era of unconstrained banking.
Unconstrained banking. I like it. What does that mean?
The old limits are just dissolving. Physical branches, human processing speeds. The moat for a company used to be having the best dashboard. Now that dashboard is a liability.
Because it relies on a human to sit there and click things.
Exactly. The new moat is owning the unique data and owning the liability for the transaction. If your software just sits there waiting for a human, you're in trouble. If it does the work for the human, you win.
Which brings us to a final thought to leave everyone with. If Goldman Sachs is using AI so they don't have to hire new analysts, and AI agents can now pay each other for services directly, how long until the economy is just software selling things to other software and we're all just kind of watching?
It's a valid question. When that transaction loop closes and the robots can earn and spend on their own, our role might fundamentally shift. We might just become spectators.
On that slightly existential note, I'm going to go ask my Agentic wallet for an allowance to buy lunch. We'll see if it says yes.
Let's look with the negotiation.
Thanks for tuning in. We'll catch you next time.
Spoken Tech for your ears.